Okay, well, good afternoon, everybody. My name's Tim Kopp, and I work at Hyde Venture Partners. I am newer to the venture world, so I've been in venture about 3 years now. Prior to that, was on the operating side as a marketer for 20 years. So it's been a lot of fun to cross over and play both sides. I'm excited about the panel that we have and want to give everybody an opportunity to introduce themselves. And I thought what we would do is spend, I've got 4 or 5 questions kind of teed up, and then if you guys would kind of keep track of your questions as we go, and make sure I kind of pull those out toward the end, if we can. Sound good? So, VC dating and marriage. You're not going to get any actual dating advice, I don't think, unless you guys have that ready. But the reason kind of for that title is I think people don't realize the process between entrepreneur and kind of funding is really kind of a matchmaking process. And it really does work best as a pretty strong analogy between dating and marriage. And it works pretty well when that process is managed over a fairly long period of time. If you're not fundraising the moment you need money and trying to get it done in 60 days, it's a lot easier when you're building those relationships, much like you would in a dating kind of relationship. And then I think people don't realize once you pick an investor as an entrepreneur, or somebody in venture picks an entrepreneur, they're stuck on the cap table for a long time, like kind of forever. And so the importance of picking a partner is, I think, more important than many people realize, and that's kind of the marriage aspect. When you're picking somebody, that partnership lasts for a long, long period of time. So I think we'll have a lot of fun. And we've got a really esteemed group of panelists, both operators, people in venture, and then I'm excited we've got a strong representation from 3 other states as well. So with that, I'll pass it over to you, Jeff. Yeah, so we'll have each person do just kind of a 30 to 45 second intro. So, kind of where they are, what point of view they're coming from, and then we'll dive in.
Okay, great. So my name is Jeff Berry. I'm a partner with Plymouth Growth Partners. We're out of Ann Arbor, Michigan. I've been with the firm for almost 10 years right now, and it's gone by very, very quickly. But so that you know about Plymouth Growth Partners, we invest only in what we call the Great Lakes region, which really is as far west as Madison, as far east as Pittsburgh, and as far south as Cincinnati. We're kind of what you would call a late-stage venture capital firm. We really look for companies that are doing kind of $3 to $8 million a year in revenue is really our sweet spot when we look to come in. But we'll go as low as maybe $1.5 million. And we have some investment product that will get us above $10 million in revenue for those companies as well. So those are really the companies that we're looking at. We've been down here in Indiana looking at deals since about 2012, and we really like what we've seen over the last 5 years, and now we look forward to continuing our relationship here in Indiana.
Hi, I'm Ron Watson with Lewis & Clark Ventures. Grew up here in Indiana, always excited to get back. So Lewis & Clark Ventures is out of St. Louis, Missouri. We are a relatively new fund. We started up in 2015 and started deploying the capital at the beginning of last year. We're a Series A and Series B fund, $130 million fund. Now have 8 portfolio companies, including one in this building, Springbok, which we're really excited about. It's doing very well. I'll stop there. I'm sure we'll have plenty of time to fill in more details.
Jackie DiMonte. I'm here with Hyde Park Venture Partners. HPVP North is located in Chicago, and HPVP South here in Indy. We do anything from C to Series A, so companies pre-revenue up through about $3 million a year. We'll write $100,000 checks up to $2 million, and really focus on that B2B SaaS side of things in the Midwest.
I'm Kay Whitaker. I'm a little bit of a contrarian on the panel because I'm with Sterling Pope Advisors, which is a CFO service helping with capital strategy. I tallied up over the years I spent in Indy, which is my entire career, and raised close to $2 billion. So I'm very good at asking for money and then helping manage over the time.
All right, share minds as we go. So yeah. So I wanted to kind of start off with the dating side of things. And when you think about dating, I think one of the most important things is a first impression. And you never kind of get that second chance to make that first impression. And I wonder what advice each one of you, I mean, Jackie in particular, you've only been doing this for a short period, but have met with hundreds of companies already. And what perspective you might share with the audience in terms of making a first impression and kind of best practices and things you might watch out for?
Well, I guess you called me out, so I can give my 2 cents from the start. I think the hardest thing with the first impression is not diving so deep that people get blown away. And so whether that's just meeting someone and doing your quick elevator pitch or going into an actual 30-minute, 40-minute meeting, it's very easy to dive deep into, here's what we are, this is why we're so exciting, this is, just go super deep. And I think just like in a dating world, if you dive right deep into your baggage, people are kind of like, okay, what's going on? And a much better approach I found is, here's my background, here's the problem that we're solving, this is the solution, and this is how we're doing it. And so as you kind of like ease down the path and guide someone through your history, just like you'd be making an introduction, I'm Jackie, this is where I work, this is my hometown, it's a similar thing to kind of pull people in close to you.
So that sounds obvious. What percentage of people do that, though?
I would say maybe 30% if I'm being flexible.
Anybody else want to share thoughts? I mean, maybe Kay, on your side, the importance of metrics, and you've been on kind of a CFO and you've raised. Did you say billion with a B? Who is it? $2 billion. That's okay. That's so.
It's a long career.
Yes, you have some credibility on the topic. So how about thoughts on your side, tips for making a quick first impression with financial metrics and telling a company story?
Right. So I've done it from the very early stage and see all the way up to taking a company public. And very, very different. But in each one of those, I'm astounded at how people aren't prepared. So the preparation, when we were taking First Internet Bank public, we probably ran through our presentation 30 times, and it was taped. And it was that meticulous for that very point. So that's like at the top end of the scale when you're raising it. But it's that important when you're going in and you're asking somebody for money, the preparation. And then the second piece is conviction, raising money for Odyssey out in Silicon Valley, being able to answer all the questions, even if the answer is, I don't know. That's a great thought. Here's how my take on it, and not sort of stalling out when that inevitable question that you can't answer comes up.
I'll give one piece. Sorry about that. First of all, when I heard the title of this talk today, it made me kind of giggle a little bit because about 6 months ago I received a phone call from a CEO who had pitched myself and our partners about 3 days earlier, and he said, Jeff, I was so excited after our meeting that, I really wanted to call. But my CFO said, no, wait 3 days, he'll be too desperate. So, it really is true that these relationships are about getting to know each other, and the entrepreneur is kind of looking to see how much they like us and how much we're going to like them. But, from a first impression perspective, there are two things that come across me, and one is what Kay said earlier, is really preparation. I feel that the companies that come into our conference room are very well prepared. I'm really happy about that. But where there's a signal where they're not, and it's really a problem, is let's say today, it's June 14th or something like that, there's 2 weeks left in the quarter, and if you're pitching in a room and somebody says, well, how's Q2 looking? How's it going to come back? And you don't have a good answer for that, that's really, it sends a real bad sign there. The other thing I would say is, there's a difference when you're pitching or whether you're meeting between what I would call entrepreneurial bravado and serious, thoughtful confidence. And really getting down the line of those two things, it's a difficult thing to do, but you seriously want to be on the side of serious, thoughtful confidence.
Yeah, the only thing I was going to add to the preparation point is I think it's really important to know your audience and what the investor does, what stage they're at. It's a really important part of your preparation process. And we talked to 1,000 companies last year, and so many of them are just not stage appropriate or they're not sector appropriate for us. It doesn't mean we don't want to have a conversation, right? But we probably don't need to go deep into your pitch if that's the case, right? So I just think knowing that your audience and who you're talking to is really important as your preparation process.
Great points. The next thing I wanted to move into that really surprised me as I moved into the world of venture was the amount of back channeling and collaboration that happens. And actually, as I look across this group, I've personally we've done work as a firm with every person up here. And so I think one of the other important things is, it sounds so obvious, but just honesty and transparency about the whole thing. A lot of times there's gamesmanship, I want to say. well, we're talking to this firm and we think they're very interested, and we just talked to Lewis and Clark. We just great. And what you may not know is we all actually know each other quite well, and so what we try to do is collaborate and talk and compare notes, and it's actually better for us if we have multiple firms in a deal. And if there's something that's not a good fit for Hyde Park for whatever reason, maybe our thesis is around something in software and you have more of a marketplace business, we're actually trying to work to actually find somebody who's a good partner for you. So there's a ton of back channeling that can happen. And would you guys mind to kind of share some thoughts around the back channeling that goes into these different deals, or kind of when that's taking place, or the amount of deals that you partner in? And maybe, Jeff, a good one to start with is you. I mean, you're Investor of the Year here in Indiana from Michigan, which is pretty awesome. You've been great partners too, clear object. But would you mind just shed some light on this?
Sure. So I think, what entrepreneurs need to know, exactly what Tim just said, is that we all do know each other. We all talk to each other quite a bit. So there's a tendency, if you're a very good negotiator, to say, hey, this other firm is very, very interested in us, and you're going to need to move fast. You want to, a lot of good negotiators talk that way. That's something here in the Midwest especially that you want to avoid, because that can be checked up on very easily. And if the other firm says, yeah, we like them, but we're not doing anything soon, that really blows your credibility quickly. That's an obvious statement. But something that I hear often here in the Midwest is, who's your competition? They'll say that to us. And I think everybody up here will say, well, in reality, there's not enough capital here in the Midwest, so we collaborate all the time. And that's really true, and that's insight that you all need to know when you're out raising capital, is that there isn't really a whole lot of competing term sheets. It happens sometimes. Actually, we competed at one a couple years ago, now that I think about it. So it does happen from time to time, but more often than not, there's collaboration.
Anybody want to add anything else on this?
I would just say there's a lot of collaboration, but I also think, if you're the person seeking the funding, you're also having a lot of conversations with different firms once you understand what their space, what segment they're in. And that's helpful to get the best term sheet. So you want a little bit of competition, but recognize in that competition that everybody's talking to everybody. So there really are no secrets. That's fair to say.
If we start to move from the dating side of this, though it's a lot of fun to talk about the beginning of the pipeline and what's happening in the courtship, and maybe you guys can save some questions for that in terms of best practices and pitch decks, and happy to sort of address those as we go. At the risk of not having time to let you guys ask questions, I'll move to the marriage side, which is, I think a lot of people have this false conception, almost the movie version or the HBO version of what a VC does. And you assume they run around and they do deals all day. What a VC, you do deals. The reality is, an active partner might do 2 to 4 deals a year. It's, plus or minus depending on life stage of the fund and how early they go and so forth. But you're spending, depending on life stage of the fund, maybe a quarter of your time actually kind of doing deals or diligence. And a lot of the rest of the time is actually working with the companies that you've already invested in. I mean, you end up being very, very close to those companies. And so maybe a couple things. I'll start with you, Ron, Jeff. What's the longest you've been involved with a company once you've sort of gotten onto the board? And then advice that you can offer. I'll confess a mistake that I made as an entrepreneur was assuming that my board was kind of out to get me. So you're a little bit more like guarded with information. You're careful about what you share. You're just sharing really good news. And I found a couple years into that wasn't such a good idea. This person's made an investment. They're already on my side of the table. They're here to help me. And if you don't tell them the real issues, they can't actually be real helpful. It took me too long to learn that lesson. But once somebody's on your side of the table, you need to, they are on your side of the table. We feel like we're actually absolutely a part of your team. So thoughts you can offer on ongoing relationship with a company?
Okay, I'll start. I think the longest I've been on a board was 6.5 years. We exited that company in January. It was a good outcome. But regarding how to interact with your board members, especially your larger investors, the way that I look at it is it's almost like a sibling relationship. You're very close. You don't always like each other. You usually do though. And you grow and you have a relationship that, for lack of a better term, is kind of intimate. And it's one of those things where, the earlier that you know that you can confide in your board members and that they're there to try to grow value, which is best for everybody, the better. When you are doing what Tim was alluding to earlier, it breeds distrust, obviously. And when you can say, I don't know, but I'll get back to you on it. When you can say, we had a bad quarter, here are the 5 reasons why, and here's what we're doing to correct that. That's how you build credibility and you bring trust, and that allows that when something really bad happens down the road, you know, they're going to be there to help, not to just complain about it. And so you share good news, but gosh, when I'm hearing good news, at that point I'm starting to get a little skeptical about what's really happening in the company. You almost lead with the bad stuff, you know, because that gives you credibility.
So the longest that I've been on a board with a company is a little bit over a year, because we've only been around as a fund for a couple of years now. So I don't have too many of the 6.5-year experiences.
You will, though.
Yeah, will, I hope, here in the near future. Yeah, I think that you said it very well. It's a very intimate relationship that you develop with the founding team. And I think if you're being a good VC, the whole leadership team of a company. So I spend a lot of time with my companies just coming into whatever city they're in and just trying to catch up over lunch or dinner with everybody across the leadership team, because I think it's important as a venture investor that you're getting information from many places in the organization, because that will help you be able to go back out and add value in many different ways. The other thing I would just say, I think as someone on the other side, as a founder, the most important thing to do when you have a good active VC on your board is to continually ask them to do things for you. I think we're well positioned to open our network, you know, open up the many sort of talented markets that we work in for our portfolio companies. But we have to be reminded sometimes, you know, so just coming to your VC and saying, hey, we really need a director of engineering, we really need a VP of sales, we really need help getting this done. You know, we actively do this all the time, but just kind of giving that pressure to, you know, kick us in the pants to go out there and work hard for you is incredibly important.
And I'll add something from an even shorter perspective, because I've only been, I guess this month is my 1 year, so a little bit shorter, but super tactically, leverage VCs for what they're good at. So there's a company of ours, and because we do seed and Series A, a lot of times we see companies kind of progress through the maturity factor of what you start tracking, the type of people you hire, things like that. So what are VCs good at from a sourcing and deal perspective, right? It's the metrics, it's the understanding people, it's the evaluation. And so you can always rely on them to help you figure out what are your key business metrics, what are the different people you need to hire, what are the mistakes you've seen, and by just pushing that off and saying, okay, what have you seen? And how do I set this up is something that super tactically you should be able to get out of anyone you're working with. And maybe this applies a little bit more to the earlier stage, but I'm sure there are different, you know, as you go through the different financing rounds, there could be new structures that are put in place.
Go ahead.
That's good. I would say you start out by saying that the cap table is with you forever and ever. So you've got your angels still. You need to have some communication to them when you bring in the VCs. So what you send out to them may be more abbreviated, and then you have the more in-depth conversations with the board and with VC members. And always sitting in the CFO seat, I typically am the one that gets to go in when the news isn't so great. And so my preference is to always give if it's not particularly great news, to be early and let them know, and then let them know what the plan is, because we'd like to say everything's always up and to the right, but sometimes you have to reposition yourself or pivot, I think is the word you're saying. So I think getting that news out earlier is best, and then it's more of that collaboration partnership.
I agree with that. Misses are inevitable. They're just going to happen. But surprise misses are not good. So signaling what's happening and that constant communication, very important. Jeff, you want to add something?
Yeah, just going back to kind of the marriage comparison is that, you know, it's one of those things where I remember with Clear Object, you know, when you're the first institutional capital into a company, you know, things change a bit. And I remember John McDonald said something to the effect of, you know, when you first came in and you're kind of all in my business, I didn't like it at the beginning, but I like it now. That might have been a year and a half, 2 years later. And what that really meant was we were working together to do different things that the company did not do, that when a company starting to evolve past $5 million, $10 million, $50 million a year in revenue, what needs to be done. And that's where the board is usually pretty good at guiding you, because if your infrastructure still looks like a $3 million company when you're doing $50 million in revenue, you're not going to be able to scale. So that's really where it comes down to. And I think from a relationship perspective, I look back at the CEOs that we've exited with, and when you've been through bad times with them, and then you exit, you're almost like, as again, brothers or siblings, because you just had that experience together.
Okay, the investor communications update is one that's seemingly boring, but I think massively underlooked in kind of the process. We have some companies that communicate every week, and we get a weekly update, and it shows a lot of color, and kind of here's what's happening in the company, and it's sharing everything from stack ranking of sales reps to uptime of the infrastructure. And then some companies I literally don't hear anything from unless I drop a note, and then you're kind of paying, like, what's going on? So what are your thoughts on, what have you learned through all that process of raising money, and kind of what thoughts would you share with the audience?
Well, I think it's really key to always have the same approach that when you were trying to get the money. If you can sustain that, obviously you're not going to do all the due diligence and all of the information providing, but if you can sustain that kind of relationship, and now you're married, right? So it's sort of like if you ran out of the house and you never asked, do you need to bring home milk, or some of the basics. So you put something simple together. With all the automation, you can put together a simple dashboard, put it out there so that the investor on their own time can look and see where you are, whatever key metrics you've decided are important for your organization. But then, at least on a quarterly basis, I think you owe the investors, even if they're angels, either a phone call, or it's easier actually just to put together those key metrics that you've decided on and distribute the report. I distributed one, and I've been writing a lot of financial information, a lot of metrics, so I can do it in such a way that it sounds pretty good. But I had one of our board members sit down and say, you really made this sound good, but it looks like there's an issue. And I go, yeah, we sucked. And then you can have that great conversation about, these are the facts, and this is what we're doing about it. But having that communication, I'm astounded, particularly in the angel phase, but VC, people will just take the money and then go silent, and that is the worst thing.
So Jackie, to swing back to you, one of the things that Jackie does for our firm, so you should know every venture firm, the way it works, you guys may or may not know this, but we have our bosses too, and our investors, which are called limited partners. And so when we're going out to put together a fund, people invest in our fund, and we tell them these are the kind of companies that we'll invest in, and we owe them updates on how we're performing against what they had hoped and desired as well. And so we actually have to do our own updates and send those out. And one of those is just kind of quarterly reporting. And when you end up with a whole list of companies and you're not getting sort of the ongoing communications, it makes that really hard. So maybe you could shed some color on what you've learned with reporting and what kind of things make your job so much easier, and what our investors want to know.
Wow. Yeah, reporting's a pain in the butt. I'm not going to make judgments, but I'll say reporting across 60 companies is a little bit more difficult than one. You should know the metrics of your own company. It's hard when you have to keep pulling them. But I would say at the very least, or what is kind of best practice, are just monthly updates with what your revenues are, what the key KPIs are for your business, and then kind of the highlights and the asks, or the highlights, the challenges, and the asks. And those make it really easy for us, both when we're talking about things internally and trying to help on a talent side or customer introduction side or whatever it is. And then also from our reporting standpoint of what's the revenue, are people on plan, behind plan? It makes it easier for us to help you and then for us to be able to communicate that out to the people who are always knocking on our doors.
Let me transition and move to another topic that's a lot of fun, board meetings. And then kind of how do you run your first board meeting once you bring investors on? Everything from I'm surprised the lack of hygiene or best practices around board meetings. I've received everything. I think my record was a 124-page board deck that was received the night before the board meeting. up to a nice, clean, crisp, 12 to 14 page deck that was received 3 days beforehand. What thoughts would you guys have, and maybe, Kay, if you don't mind, we can start with you, because you've kind of managed those from the CFO side. Thoughts on how to really manage your board and how to best bring them up to speed so you can have productive meetings. So what information is helpful to share, and then actually kind of in conducting those meetings?
Yeah, so I mean, the first thing is respectful of the time for board members, because they're all very busy. They've got 60 companies that they're looking at, and so starting out with the agenda, you set the agenda with the chairman of the board, and that sets the tone. And each board meeting should have something of a theme. If you're in an acquisition mode or whatever, your growth stage, whatever you're trying to accomplish, that should be the theme of the meeting, and don't go wandering off. As much pre-material as you can provide, and that should go out at least a week ahead. And we're talking best practices. So at a minimum, you should have your financial reports. There should be a dashboard that you've agreed upon. The board wants to see every single time, and you ought to have that at your fingertips so that you can report out on that. The agenda should typically be the chairman's comments, and then literally walking through what's the state of the company, what are the operations, what's going on. Keeping those segments just sort of what I call the administrative, the minutes and all of that. And then you do the financial report, and then you get into the meat. And a successful board meeting is when you've got your board members, and think of the talent you have on that board once you're at the VC level. But you spend at least an hour, maybe two. I've had some where they insist on 5-hour board meetings once a quarter, right? And that you can really get into a detailed conversation, because then you're really sharing, you're developing that relationship, and you're really expanding and developing your business, and you're talking strategy. When your board is asking you about the $3.22 spent on the beer, for that party, that's not the conversation you want. You want the, okay, I'm seeing this person, and we need to go over here and change it up.
Yeah, so when we onboard a new portfolio company, we have a kind of playbook that we run, and one of the things that we do is we spend usually a day with the company just working through, here's how we want a board meeting to work, right? And a big part of that is developing the board deck, and what we've really tried to push is all of the update stuff pre-board meeting, right? So get us all the financials, all the KPIs before the meeting. Sure, we need to have a short period of time where we can discuss things that we might need to dig into that we've noticed about the business, but ideally, and we do have a lot of 4-hour board meetings, ideally those 3.5 hours are being spent digging as deep as you can into the core strategic issues that the company is being faced with. So anything that you can do, I think, as a founder to really get to the strategy and get away from just updates, you should be doing. One other board best practice that I'm always blown away by coming into new boards is you got to have an executive session, right? So you have to have, I think, ideally you're going to bring your leadership team in to the board meeting. At some point you need to send your leadership team away because you might need to talk about them for a while and how well they're doing or how well they're not doing. And then if you have critical mass, it probably makes sense for your investors to have some time at the end of the board meeting without any of the company being present. And I think if you have that discipline with all of the executive sessions, you can get so much of the discussion that you need to get done in the one day rather than having it bleed out into the next couple of weeks.
Yeah, I was just going to say something relatively similar. The rule of thumb that I like to see for a board meeting that's mainly institutional, at least one VC fund on the board, is that a quarter of the board meetings for reporting, the other 3 quarters are for opportunities and challenges. That's really the way that I like to look at it from a rule of thumb perspective. It doesn't always play out that way, and frankly, I've had board members that really said, I'm here to be reported to, and that's not usually what we think of as the best board member, but people won't always agree with me, but I like the rule of thumb of a quarter of the time for reporting, 3 quarters for opportunities and challenges.
If I turn it over to you guys, might anybody in the audience have questions? If not, I have some that I can keep ripping through, but by show of hands, anybody have a question? All right, I'm going to keep. Okay, yes.
I have a question about the board meeting, the shareholder part. What kind of things would you talk about that you really want to include the company in your part?
So the investors, but, oh, sorry.
Repeat the question.
Yeah, so, sorry, good, thank you. So the question is, what would we talk about at the very end with just investors present and not any of the management team? Is that correct?
Yes.
Yeah, so typically, your role as a VC, and often we'll have independent board members in these sessions as well, is, to give critical feedback to the company. And often what you're doing in that time is really kind of organizing those thoughts and figuring out how you best communicate it back to management. I will say though, in some cases, that conversation might be about the founding team itself and whether they're the right people to lead the business to the next stage. One of the unfortunate things that you have to do as an investor sometimes is change out top people in companies, and that is where you would have that conversation.
Yeah, I'll just add on to that by saying, on a positive note, if they had a great quarter, a great half of the year, the team is really performing. We say, look, we want these people to stay in place. We want them for a long time. We want them long term. Let's talk about option allocation. Let's talk about comp on a whole, because we know we do it every November, but I think we need to do it now in June simply because the last 6 months have been outstanding. So that might be another thing that we're going to go in. And it can also go from just some frustration. You might say, look, I've been telling the CEO forever that now is the time to bring on a COO. They've evolved to that point, and he's not listening. What can we do to get this point across? That if they're going to cross 10 million in revenue, the CEO can't be doing anything. He needs a COO alongside him.
Yes.
So what are the basic things you look for in a successful field? Are there any metrics like year-over-year returns or how you improve the product is? So like if I want to come and pitch to you, what are some of the things that I need to highlight to make it happen?
There's a little bit, I'm probably getting old, but I had a hard time hearing all. There's like air conditioning. So what are the key metrics that we would want to hear from you? Okay, great. Well, I certainly have thoughts, but I need to do my job as moderator and turn it over to the panel. So, okay, maybe like there's two things, I think, from a reporting side and then from a sourcing side. It's kind of like pre-investment and post-investment, how those go together. Jackie, I think you have probably heard more pitches, I would say, than everybody on this panel combined over the last year, would be my guess. So I might start with what grabs your attention and would cause you to escalate something up to the partnership?
Yeah, I'll say there's two things that kind of get a VC to kind of put hooks in a deal, and one is kind of the qualitative, and the other is the quantitative. And so from a qualitative perspective, it's just kind of a checklist of things. It's a repeat successful entrepreneur. It's someone that inherently felt the pain and has a conviction on their solution, comes from the industry, or innately knows the problem and solution. Any number of things on kind of the founding team with a very strong connection to the industry they're going after. And those things, when you start to see that and hear those stories, you're like, maybe they're not that far along, or maybe the metrics are a little off, but like it's kind of that factor that you have, and so you bubble those things up. And then the other side of it could be an industry where we're very generalist at Hyde Park, right? So we talk to folks across many industries, some of which, like marketing, I would not trust my evaluation. We would bubble that up to Tim, but something in IoT would be probably evaluated by me versus Tim, right? So when you're talking to CEOs for those companies, that's where the metrics really become the hook, and that's when you know when to pass it along. So from a seed perspective, and these are kind of just thresholds, right? It can be 25 to 50K a month, right? If you're showing that traction with 10% growth month over month, something like that, you're like, okay, you have something there. You're selling, you're moving along. Similarly, with Series A, once you get into what we say 1 to 3 million a year mark, and so when you have those baseline metrics, and then can start to show some of those things like low churn, some natural growth within your customer base, things like that, that's when you start to bubble things up, even if you don't know about the idea or the industry or the market.
Yeah, I think the things I hear you talk, like when you bubble something up, it feels like it's, correct me if I'm wrong, but year-over-year growth, so we talk growth, and then you talk recency of growth, month-over-month growth, and kind of is growth increasing or decreasing. We talk about unit economics, and a little bit around burn and cash efficiency and kind of how those are. So I don't know, if you had to pick three, would it be those three or what?
Yeah, I would say the first three that you mentioned, year-over-year growth, month-over-month growth, and then just straight up what your revenue is, are enough in the first conversation to kind of make the switch. All of the other things are important, and they kind of validate where you're looking at, but I think from a sourcing perspective, if you're just having a 20-minute conversation with someone, that's enough to kind of say, okay, there is something there, and then be able to ask the questions of, what is your burn? What's the churn? What are all of these other metrics that go on? But you have to kind of get those initial ones to get those other questions.
I would add one. So one thing that I also like to dig into very early in pitch conversations is what is your actual market size? So what is the market that you're selling into? And I find market size to be the most frustrating thing to talk with entrepreneurs about, because either they just don't understand how to size the market, which I doubt, or they just refuse to kind of look at the real way that you would actually size the market if you were, an objective observer. So everyone comes in the door saying they have a $50 billion market, and we may have seen one business that actually has a $50 billion market they're selling into. So yeah, I just think market size is really important from the get-go.
I think someone once told me that their market was vertical SaaS, and so that was their market size.
Yeah, and what I'd like to add is, I think because they both invest a little bit earlier than we do, but we're all of us here are looking for revenue-producing companies, all right? And it's a different answer for those companies that are looking for seed rounds, pre-revenue companies. So for those that are looking for revenue, we're really looking for growth, on the top line. That's what's most interesting, that plus the strength of the management team. But to answer your question, if we're talking pre-revenue, it really then gets much more about product, much more about the team, and really being able to believe in whether they're going to be able to commercialize this thing and take it forward. So it's a really different answer from those funds that are looking for strong revenue-producing companies versus pre-revenue and seed rounds. And it's much more qualitative, obviously, for pre-revenue and seed round type companies.
At the risk of jumping in, I'll share one thought on this, which is when you're pitching, the key objective is not, I've created a 22-page deck, so I worked hard on these, so I'm going to take you through every slide, whether you like it or not. So sit down, here's all the slides. The best conversations are just that, they're conversations, where the deck is a backdrop, you've got all the slides, somebody asks about revenue, you don't say, we'll hit that later, you just say, good, glad you asked, that's on page 7, and it's here. So realizing that that's more of a sort of a guide or a template, but the faster you can get into a conversation, I think it's better because it becomes far more interactive. Any others? Yes.
I'll throw it out.
Please.
So at least in Central Indiana, there seems to be a perceived gulf or increasing gulf between angel investing, kind of that seed round, early revenue versus real growth revenue, the A and B round, and the perception that VCs are moving later and more de-risked, for lack of a better term. It sounds like maybe at least a couple of you folks would play a little bit more in that middle ground, but I'd like to hear your perspective of whether you see that as a trend and then potentially troubling trend for growth venture, and then also what role you might be playing in that space.
Sure. It's a very good question.
Yeah, it is a trend, and it has been for about 3 years, where a lot of the more institutional funds here in the Midwest as well as elsewhere are looking to see that there is revenue on the plate. I've seen firms that used to be looking for 500 to $1 million to revenue now going up to saying we're looking for 1.5 to 2, and it seems to go all the way around. And that's why a real vibrant angel community is so important, because they're investing in their backyards, they're investing. They want their kids and their grandchildren to be able to be employed in tech down the road. And so there's more of they want returns, there's no doubt about it, but there's also a little bit more of their heart into it. So you know, when we look at government's role in the economy, and there's a big debate about that as to whether it's something that should be done, but really where the help needs to be for the most part, and this is against my own self-interest given where we invest, but you know, a lot of help needs to be in that seed and Series A round. You think about financing continuum, which is friends and family, to the seed, to the Series A, and Series B, Series C, to growth and private equity. You're really, each state needs, you know, a pocket of money in each of those areas. If there's a gap somewhere, things stop. And a lot of the states around here have learned that, and they've done a relatively decent job of addressing it, but it's always has to be on the minds of the economic development folks and the private sector, which is trying to address it, is that there isn't any Series A funds in a certain market. Hey, that's a great opportunity for somebody to raise a fund and to address that.
Yeah, I think also worth adding, I do think part of like the Midwest is we're conservative, so people have pushed a little bit further along where they have a little bit more traction, they feel more comfortable that the company's going to be able to take off. But I think there's another reason why investors have waited for a little bit more revenue, and that is you can start, especially in software, a company for nothing. You know, just very, very little upfront capital. You can get to market, start doing an MVP and really sort of iterating on that product before you have a huge team or you've had to, you know, spend a lot of money on capital. So, you know, I think it just makes sense, given that, you know, you can spin up a company so quickly that investors are going to wait around and say, show me the money.
I would add that how you raise money in New York and Silicon Valley and the Midwest. Midwest does want, they want revenue. They really want to see that this is just what you said, that it's a viable concept, whereas, you know, most accelerators, if you went through their program, they'd say, oh, well, pretty much every company starts out valued at $2 million before their pre-revenue, and so in Silicon Valley it's $6 million. So that it's, if you're just selling an idea and a dream, then you might want to move where you're pitching. But if you are committed to the Midwest, then always focus on revenue and focus on this business model being able to run as opposed to just an idea.
I think the one point on that, though, when you think about de-risking and having no revenue up through having great amounts of revenue, and in that pre-revenue stage, you start to see angels, you start to see some seed institutions play, but kind of what happens through the funnel and the growth is going from, you know, 10 or 15 investors in the seed round, right? Because they're all de-risking their investment. To, okay, you have a little bit of revenue, and so someone wants to step up and lead, and then there's, you know, 4 or 5 people around the table, and then you get to that growth where you actually have some significant revenue and you're, you know, growing quickly, and that's when you have more of the growth capital taking more of the round, right? So there's one investor, and then the others that kind of fill in the rest. And so both from a company perspective, but then also how we work together as institutions and angels, you see these people working together and kind of de-risking their investment, and as they have conviction, and whether that grows through revenue, through users, whatever kind of those core metrics are, people want to take more and more a part of, or be more and more of a part of the company. So you see that in kind of both sides.
Jared.
Jeff, I want to direct this one at you. So just following up on Todd's question, have you seen a dearth of capital at the earlier stages affect quality and even quantity of the deal flow that you see?
I will tell you, when you're pitching companies and you say that's a great question, we all kind of look at each other and we're like, gosh, we do that all the time, you know. But that is a great question. Okay, for growth stage investors, our pipeline is based on how good those seed rounds and those Series A rounds are. So when we see new funds pop up, be it a $15 million fund, $20 million fund that has a good group that is investing, and they're investing $250K into a seed round or $1 million into an A round, we're thrilled, because that means our deal flow is going to become so much better. So we look at these, a lot of them are first-time funds, and we just root for them like you wouldn't believe, because they really make our job easier down the road, and it's a great source of deal flow for us. So when we see robust seed funds and Series A funds, we start to feel, hey, we're going to have good deal flow over the next 3 or 4 years. Thanks, that's a good question.
How are we doing on time? Do you need us to?
One more question, if there's questions that I can ask. No?
Oh, looks like there is one more. We'll do a speed round on it.
Yeah.
Right.
The question is just, you know, how do your portfolio companies ask for help, right? I mean, are they timid kind of coming to you, or I mean, I think they probably want them to ask to you for help when they need help. If you can just kind of talk to that.
Yeah. I think you'll find the answer varies, and a lot of it varies on how seasoned of an entrepreneur. The second time through, it's a lot easier to ask, but curious what you all think.
Yeah, it really does vary across the board, and I agree with Tim. When it is a seasoned entrepreneur, they really look at themselves as peers to the board, as well they should, okay? So they're very comfortable in saying, hey, you know, I've got all these iBanks calling me, or I have all these, you know, billion-dollar venture funds from the coast calling me, you know, can you help and take that off my hands? And we're happy to do it. You just need to, you know, as an institutional investor, we need to be clear to the entrepreneurs what we're there for and where we have expertise, and to let them know that if we're not doing that, we're not doing our jobs. They need to feel comfortable to come to us with questions and asking for help. Otherwise, there's really no value add. And if we're just providing money, we're failing.
I think it's a perfect way to wrap, actually. So thank you, everybody, very much. Thank you to this whole group of people. Like, I think we could not have had a better group of panelists.
Thank you all for coming. Absolutely, we appreciate it. And this point you made about all the VCs kind of knowing each other, I find that to be so true in my practice across the country. I had one that I worked with for 4 years, and he left and said, you know, I'm going somewhere else. I'm so sorry, our relationship will end. The next week, apparently, he was going to be the DC at a new fund that I also work with. It's like, surprise, it's me again. Go away. So thank you all so much. We're going to have a quick transition about 5